Welcome back to another Market Open live stream. Finally, a little bit of red in the market. You need it. You need to have a little bit of red in the market. You can't have the RSI basically over 80 without red in the market. Take a look at this. If we jump on over here and we look at the day chart for the SPY, we look at our relative strength index, we are at 81. 81 on the RSI. You can see that right here, 81.47. We have not seen those sort of numbers, like an actual 81. I mean, we've seen like 77 in the summer. We almost always drop right after that, by the way. 77 over here. We've got a 78, 79, it looks like, right here during the November 2021 era. We go back out to where we have COVID. Here's COVID. I think it was June after COVID we were this high. Go over here. Yeah, here's September after COVID. 83. You've got June after COVID. It was June and September. 76. You almost always have a drop right after that. You've got to have some kind of correction. Now, it doesn't have to be big, but we're right there at a fib retracement line. But it is very normal to have some red when your RSI breaks 80. Almost certainly. Usually it breaks a lot faster than that. So a little bit of a breather would not be a surprise. And that is not a breather that says, oh, anything's broken, the rally's over, that's it, this is the end. It's really just a healthy breather almost for the market to just relax a little bit, and for money to maybe take a little bit of break with flowing into the market, because boy, there's been a lot flowing into the market. In addition to that, there's actually a company that just downgraded Costco. This company, North Coast Research, cut Costco on or from buy to neutral, reflecting their position as a premier retailer, as well as the next membership fee and high valuation. Wow, interesting. Now, Costco isn't raising memberships, but this company is basically saying the next membership hike is already priced in. I personally actually don't think they're going to raise membership fees, but we'll see what happens. Maybe they will. And they argue here the valuation is high. Now, that's also what I've been arguing now for, maybe 5 days now or so. I've been a little bearish on Costco, mostly because of valuation. And that doesn't mean the stock's going to go straight down. They've got a big dividend getting paid out in about 3 weeks. So you have to be careful, because if you're short it, you got to pay it out. But the stock should adjust by that amount anyway. But what happens after the dividend, I think that'll be really interesting. So that's just my take on Costco. Obviously, yesterday we heard all of the drama regarding Donald Trump and expectations for what that could mean for America. Most folks are pretty surprised, no matter which side you're on. If you haven't seen it yet, though, we did update our full thesis here on HouseHack.com. And not only is this our full thesis, but it's a lot of fact pulled directly. Some of the things that we found are most interesting arguments from the actual case. We have the screenshots of those right here on ehack.com. So if you want to see the most interesting pieces, check those out. Just all data here, right next to this this Tesla, which we made a video on, but this Tesla car accident claim disaster. A lot of people here are worried about that this was not adjusted by how many miles people drive, but Tesla drivers actually drive, from at least the research we were able to do, less than non-Tesla drivers. So I don't know that part of the data really helps. But I think put it all in. Make sure you have age, sex, and total miles driven in the analysis, and then make a proper outline, so to speak, or proper research report. Anyway, my take. So then, what else do we have? Well, today, let's see, we should have data like right now. Let's take a peek here. We have mortgage applications down 1.5%. And let's see here. No, I guess really the next Most interesting data that's going to come out, we'll get existing home sales at 7, consumer confidence at 7. More interesting will be tomorrow, actually, 5:30, when we get GDP annualized, PCE, and jobless claims. So that'll be tomorrow at 5:30 a.m. We'll get to cover those. So next, we have over 100 container ships rerouting after the U.S. is weighing this Red Sea response. And this Red Sea response is one that a lot of folks believe is it could lead to an escalation. If you look on HouseHack at the top here, you can see the U.S. military is considering military strikes against the Houthis. This is something that I've warned of in the past, that it's not just a matter of getting troops or let's say warships to the area to defend and escort, but there's also the risk of escalation that follows strikes against Houthi positions. So not great. Not great at all, but completely understandable why the United States would want to escort their shipping partners just to minimize supply chain disruptions. Adding about 15 days to seaborne shipments is not ideal, especially in a very inflationary time. So we'll see how this continues to evolve. I do think I do have a nice little breakdown here that I'd like to throw up. Give me a sec here. And it's basically a chart or a map that'll show us that a 3-part breakdown of the difference between the strait where the attacks are occurring, the Red Sea, and the Suez Canal. So you can really see how these 3 things are different. So let me grab that for us really quick. I should have it here now. This I found fascinating because a lot of people have been very confused about these 3 items, and we have those on screen here now. Here you can see the Suez Canals all the way at the top as you break through Egypt to get out into the Mediterranean, and you could pit stop Israel in the corner, so you don't actually have to go through the Suez. You've got the Red Sea in the middle, and then there it is, the one that I have trouble pronouncing, the Bab al-Mandeb Strait. Now remember, and I don't know how to pronounce this one perfectly either, but the Strait of Hormuz, whatever, is actually right here. And look how tight this gets with ships right here. Goldman Sachs believes this is the area we should be most concerned about. This is where we had one of those ships run aground and block shipping for a while. Of course, ideally, we just don't have any maritime disruptions. Anyway, yeah. All right, let's see what we've got from a market's point of view of... see if usually the 5 o'clock hour I prefer CNBC over the 6 o'clock hour because we get less of Jim Cramer pontificating and more of CNBC providing some news. But that's just my take. So we'll wait for them to come back off of commercial. In the meantime, let's see what the suits are saying this morning. Futures, obviously, we know are red, but not only are futures red, but we have bond yields red. This is the first time we've actually seen the 10-year Treasury in a very long time. Since at least substantially earlier in this year. Yeah, I would say since, actually not even that substantially earlier, this summer. This is the first time we've seen rates under 3.9% since July. That is interesting. It just doesn't feel like... It feels like it should have been longer. But this spike we had in yields was very, very, very short-lived. If we look at it from a calendar point of view, it felt so painful for so long, but it was really this 6-month cycle, and it sort of aligned with the stock market declining there starting in July. 10-year Treasury now down to 3.87. I did notice the 5-year break-even, by the way, is dropping. Actually rising. The 5-year break even is the market's expectations for inflation. I've started to see this move up. We're sitting at about 2.94% on the 5-year break even now. A little bit elevated here relative to the lows that we hit before Jay Powell's cuts. Part of that may be due to expectations that higher rates may be necessary to actually drive inflation down. That may be what the market is trying to price in with these bond market expectations and moves in the bond market expectations. Who knows? Let's listen in over here for a moment.
And we have a 20-year auction today at 1 Eastern, $13 billion, and auctions are a biggie. And one final point, the newest whisper on the street wouldn't please Jay Powell or any of the purists that follow the United States Federal Reserve, because most of the sources I talk to think that cost to service debt and an election year in 2024 are both having an impact on future Fed policy. Becky, back to you.
Rick, thank you very much.
Okay, meantime, in just a little more than 24 hours, Apple says it's going to stop selling the Apple Watch Series 9 and Ultra 2 on its website in the U.S. That is, unless the government steps in or Apple can resolve a patent dispute with a company called Massimo. Now, this stems from an October order from the U.S. International Trade Commission that could prevent Apple from importing the watches. The commission found that Apple violated Massimo's patent rights surrounding the measurement of blood oxygen levels. Should it choose, the Biden administration has until Christmas to veto the Trade Commission's order. Join us right now to talk about the implications for Apple's stock. Walter Payek, he's of Lightshed Partners, of course, joins us on the telephone. How big a deal is this in the grand scheme of things for Apple and maybe even more broadly in the sort of patent war?
Not.
Yeah, Andrew, I don't think it's a huge deal, whether quantitatively or qualitatively, meaning that...
Yeah, remember, Apple Watches represent maybe like 5 or 6% of Apple sales.
It really represents, less than 5% of revenue. You're still able to buy the product, Walmart, Amazon. The wireless operators sell these things when you want them connected to LTE. So the quantitative impact is not large. Typically, you see these things resolved one way or another fairly quickly. Same thing qualitatively. I mean, this is not really a brand hit. These things happen from time to time. I don't think the typical consumer is going to read the headlines and say, this is something bad about Apple not developing something properly or doing something, at least it's not perceived as devious in terms of getting the technology from this company. And then thirdly, Andrew, you mentioned Biden. I mean, aside from the fact that the company that is alleging these thefts is a U.S. company, right? You also have, a regulatory group that Biden has appointed that is really not pro-large companies on an issue that it's, something that's negatively impacting a small company. So I'd be super surprised if the Biden administration would do anything in this case, not only because it's an American company, but because it's Apple,
Right. Well, Walter, but just handicap what happens next. So you're betting that eventually Apple settles with this company. Are you betting that they come up with a different technology for future versions of the watch and effectively try to bypass this company? They take the feature out of future watches. How important is the feature? What do you think?
I mean, first of all, I had totally forgotten personally. A friend of mine recently got COVID, and I'm like, the only reason I remembered they had this was because of this suit that was going on. So, yeah, I don't think that this is a necessary element that would swing sales one way or another if, they actually had to pull the thing out. It obviously hurts their brand in terms of being a health-focused company. In terms of the company, Apple is a dig-in-your-heels type of company that they fight things rather than taking the easier route. I think they've already demonstrated that. So anyone that thinks they're going to buy this company when the largest company they bought was, I can't remember how many years ago it was now when they bought Beats, right? I don't think you're going to see an acquisition. Maybe you'll see a settlement, but I think they're going to try and drag this out as long as possible to reduce, their impact. So, we'll see. We'll see how that progresses.
But when you say drag this out, if they can't distribute them online, and can they can distribute them through stores, so they can still manufacture them under this provision.
Yeah, I mean, you can sell them there's a lot of other distribution channels. I don't know what the mix is for the watches, but for cell phones, most of the phones still get sold through the carrier stores and the carrier.
I think what the guy is saying is that there's still an inventory buildup. I don't believe that Apple is going to have the ability to keep importing these manufactured watches into the United States. But the guy's basically arguing that, hey, we still have like a ton of places with a bunch of inventory where you can buy these. I personally still think this news could actually create a little bit of a marketing, like a free marketing rush, because I don't actually think most people love hearing about lawsuits or patent disputes. I think a lot of people are like, let me buy what I want. And therefore I think you actually create a bit of a marketing push for free to some extent for Apple, or maybe you could end up pre-selling a lot more inventory than you otherwise would have. In other news, BlackRock did meet with the SEC. Now, I thought this was interesting regarding their Bitcoin ETF for like the 5th time now, which is absolutely remarkable. We've had others having multiple meetings, also with the SEC. iShares Bitcoin Trust is at the most. We're at like 5 meetings. Grayscale Bitcoin Trust is at like 7 meetings, I want to say. So actually, I think Grayscale is a little beat BlackRock a little bit more. Kathy's met with the SEC, her team once. You've got some of the other ETFs like Wisdom Tree and Invesco. They've had 2 meetings with the SEC. HashDex twice, and these meetings are meetings between the actual ETF provider, the NASDAQ, where these ETFs might be listed on exchange, where they're traded. And then that's, by the way, the NASDAQ would be what like a Robinhood or whatever would connect with. And then the Office of Market Supervision in the Trading and Markets Division. So what is that? Well, when you hear supervision, and I know a lot of people really dislike the SEC, but it's worth recognizing that there's a regulator in finance, there is not in crypto. When you have a regulator like the SEC, their job description includes supervising that the prices of certain securities trade within bands, so that way there aren't like ridiculous mispricings. Excuse me. They also need to ensure that the commissions or compensation, markups, markdowns that are charged to the customers are in the best interest of the customer. Like if somebody goes to an exchange like the NASDAQ and says, hey, I want to buy, your stock for $100, and then there's another market maker that's like, well, I'll sell it to you for $103 because I want to take a $3 more commission. It should be on your broker to direct your trade to where you're going to get the best price. Now, obviously, that creates issues because there's this, we go back to like the Citadel days of Robinhood. It's like, well, they're getting all this payment for order flow and, commission-free trading isn't really free. Well, duh. But point is, these meetings really lead into the Bitcoin, structuring all of this sort of information gathering and supervision. So that way the SEC can, do what they are, what they believe they're responsible for. So that's like a super, super high level overview of how to consider crypto regulation. And when it comes to just market supervision on an exchange. But not only that, with an ETF, there's some practical implications as well. Who's going to store the Bitcoin? That's the custodian, right? Who clears the transactions? Is the DTCC available to do it? Or is the CFTC going to do it? Who's going to do it? And theoretically, that could be somebody like a Coinbase as well. It doesn't have to be a DTCC. So all of these things, though, are going to be things the SEC meets with these companies on to review a Bitcoin ETF, and that's what they're in the middle of. I still believe that the SEC likely wants to get through their lawsuit with Binance, which we just saw an increased settlement between Binance and the CFTC DOJ claims. DOJ was at $4 billion, CFTC's at like 2.7, 2.8. still have the SEC out there. So SEC still has some work to do when it comes to Binance. So we'll see what ends up happening here. Then we've got mortgage demand. You know, what's actually interesting is mortgage rates are starting to trend down closer to about 5%. It's kind of wild. Big move to the downside from the about 8% we had here at peak not too long ago. So we're definitely starting to see more home buyers come out of the woodworks. This is, I mean, they're right around Christmas time. It's very interesting. Again, like the only people who are selling, I'm looking, it's like probate sales, trust sales, and we're getting involved on where we think there are good deals. Over at HouseHack, which if you haven't seen the valuation update yet, go check that out. On the HouseHack channel, it's linked down below. But boy, you are starting to see a lot of even the conventional buyers come out of the woodworks. And it's very evident that the lowering mortgage rates are having a very optimistic effect on people's willingness to buy real estate. Very, very different from the pain that we saw in October when rates were at their highest level. So, okay, very good. So let's see what else we have here. Then let's see here. Then we've got... somebody here is asking about fees for an ETF. Well, if you want to run your own ETF and pay $500,000 a year in fees to run your own ETF, there you go. Sometimes people are like, "Oh my God, I can't believe an ETF has to pay for charge fee." Do you want to pay for all of the bills that I have to pay for it? You could do that too. You could pay the exchange. You could pay the banks. You could pay the trust, the trustees on the trust. Go for it. Go do it yourself. Pay $500,000 a year. So it's kind of funny. People forget that there are actually like real expenses involved, and I think they're very high. I think they should come down in the long term. I'm a big fan of ETFs lowering costs, but that happens with scale. So next, Z told Biden at a summit that Beijing will reunify Taiwan. They always say that. I always think that's very funny. They always have this saber rattle, so to speak, in China of, we will reunify. It's like, okay. All right, we know you want to negotiate. Let's listen to this dude talking about financial risks.
And then whether putting an interstitial, a marker, or a banner on it, say, hey, this is fake, you may want to think about before you amplify it.
What you said from the idea of a paralegal using AI to generate a letter that they send to a customer, I hadn't thought about that because I don't think there are a whole lot of companies that have really put the clamps down and said you can't be using AI, period. And if they are, I don't know how well they're enforcing it through the ranks.
There's kind of a range or a spectrum of approaches and policies. The furthest out that I'm seeing is mainly the big banks do is a very restricted lockdown approach to generative AI in the workplace where you only use private models, and that's going to be using the big common,
all right, this guy's boring. Somebody here suggests or wonders, hey, is it time to go to small caps? It's interesting. Usually, when you start actually getting big rate cuts, small caps do pretty well. That is very interesting to me. So it's something I've been paying attention to, and you definitely see risk exposure increase around the time of euphoria. So there's definitely this potential to invest in small caps. Yeah, I don't know. This is a weird discussion y'all are having here on ETF fees. Jonathan's right. The fees don't even cover the costs of running an ETF. Exactly. Yeah, what I think is funny is when I created my ETF, I said, don't invest in it. Like nobody needs to invest in it. I created it for myself. Because the tax benefits of ETFs are so remarkable. In case you haven't heard or been sort of enlightened into what the tax benefits of an ETF are like, the tax benefits of an ETF allow you to exchange stock without having to pay taxes. Now, obviously, unless you have your own ETF, you can't make that exchange. But if you have a fund manager who operates stocks in a way that you would like them to be traded, then, for example, what you could do, as a theory, is you could really overexpose yourself to, let's say, Tesla. And then you think there's this potential for Tesla or even Enphase to have a euphoric rally, say the summer of 24 or 2025, whenever that occurs. When that occurs, you can actually exchange those potentially, if there are gains, right, highly appreciated shares for other shares. Like, just to make it simple, you can move from, let's say you have we actually had a real example like this. We had somewhere around $3 million of gains in the ETF. A lot of that was Apple stock. And then what we did is we exchanged it for, I believe at the time, it was a little bit more Tesla and a little bit more Enphase and some other stocks. I think we opened a couple positions. But anyway, what was really interesting is we moved down from something that had larger gains. And a 50% tax rate normally on short-term capital gains, which these would have been, state and Fed combined, depending on your tax bracket, obviously, that potentially saved over $1.5 million. And so then people look and go, wait, so it costs $500K to operate the ETF, but in one trade, you're able to save potentially $1.5 million of tax obligations, right? So I think there's a short-sightedness that can occur in finance pretty regularly. People kind of misunderstand priorities or how systems work. But I think that's very interesting. I think it would be cool for ETF fees to be lower, so that way everybody who's watching, for example, could have their own ETF. And if somebody had the ability to do that, if you had the ability to make your own ETF, I think you should do that, because then you could have your own control of making these sort of exchange trades. They take a little bit of time to process, like in the practical nature of an ETF. They take some time to exchange, because you basically have to find an exchange partner, so that way you're not touching the money, basically. So, but from just a technical basis, right? I'm not like here to pitch any product or anything. Just from a technical basis, the way ETFs function is very, very, very lucrative for the investors to minimize tax risks. Assuming obviously there are gains. So it's very interesting to me. So the same will be true, by the way, of the Bitcoin ETF, but not so much because that's the same, product basically. It's not like you're going to exchange from Bitcoin to Bitcoin. But once they start coming out with other ETFs like Bitcoin and Ethereum ETFs, then you could trade between the two. Isn't that great? Yeah. So anyway, now one of the things I say thank you for saying you love eHack. Hopefully you're not going to monetize it for all. I have no plans for monetizing it. And I have, in terms of like ads, although, it obviously might make sense in the future to have like a Meet Kevin product on there, but I have no plans for third-party advertising, and I have no plans for ever charging for what's on eHack. Really, right now, it's been just a function for me providing the best value that I can on even YouTube, just because we have a very clear outline of our research, as we do it throughout the day, so it's very, very exciting. Okay, good. So let's consider what if Kevin is wrong regarding the housing market. The good news is when we buy homes or multifamily buildings for HouseHack, our view is that we buy those deals inexpensively. That we buy them for maybe a 20%. Or with a 20% insulative buffer. And everybody should do that. You should have a buffer. And so really when we do that, even if the market falls, you really have to get through a lot of insulative fat to really actually hurt HouseHack. So we're very, very excited about that. And we've done very well so far on our exposure and the insulation that we have, and obviously our opinion. So, okay, good. Let's see what next. Let's go look at what the suits are saying. Stocks face hit from darkening earnings environment. A disappointing double blow from earnings misses at the freight firm FedEx. And food manufacturer General Mills highlights the risks equity markets face from slower economic growth. Well, that's kind of why I'm a little nervous about earnings season. I generally have been for the past 2 years. It's don't expect some big old beats across the board. Although, like we saw yesterday in the Meet Kevin podcast, Ulta beat, but boy, they're starting to talk about price declines. It's very interesting to see. So when you look at FedEx, their adjusted EPS came in at 3.99 versus the 4.1 expected, and they previously were looking for flat revenue growth. However, they've actually now forecast a low single-digit revenue decline for 2024. Very interesting. So seeing some of that decline in BTC is fascinating. Yeah, insulated buffer equals margin of safety. You're right. Absolutely. So, yeah, let's take a look here. It does look like, BTC is moving a little bit on this excitement over the Bitcoin ETF coming around. We've got 43,600 up about $1,500 here from some of the lows over just the recent days. Let's listen in here.
Bottoms a little bit. So the 2023 was characterized by not a lot of help coming from China. So that comes back a little bit. You point out that the Fed was able to raise rates quite a bit without seeing the deleterious effects in the U.S. economy. So that has us at relatively high levels where when things are refinanced, and they won't come down that quickly, in your view, because the landing won't be that hard. So it's a different rate environment with less stimulus left.
Yeah, right, exactly. I think we've seen the downturn postponed. I don't think it's been entirely cancelled. And we don't see very, very aggressive Fed cuts next year, certainly not as much as what the market is pricing in. But, I think the key message that we've been getting from a lot of the inflation data, you've just seen it from the UK as well this morning, global disinflation is clearly underway. So there is going to be a pivot. There are going to be cuts next year. It's just not as much as the market is pricing in. And I think that does add potential for volatility in the first.
Wow, we have no idea how much we're actually going to get in terms of cuts.
Fed, you name it, all of these central banks. Then I think risk assets can maybe be on to more of a sustained rally after a bit of a wobble, probably in Q1 of next year.
So
yeah, it wouldn't surprise me actually to have that wobble she's talking about after earnings.
3 pretty good months since we've had October lows 2 years in a row. So you think maybe the first half of the year is more of a backing and filling?
I do. So I think there's 2 risks out there. One is just that the market starts to realize that their expectations for rate cuts are a little bit too optimistic. So you could see a bit of a pullback. On the other hand, if they're correct and you're going to see rate cuts as soon as March, that to us suggests that you're looking at a deeper economic outlook, a worse economic outlook than what is currently expected. In which case, the earnings expectations, which is still a little bit optimistic, starts to come into question. Again, you don't exaggerate it. It's really more of a wobble and volatility because at the end of the day, come Q2, end of Q2 of next year, you're still going to see those rate cuts. And any economic slowdown that we've all been fearful of comes through. So at least that uncertainty is behind you. And that slowdown doesn't really inflict any permanent damage to the economy. So there's some relief. It's just that you go through a couple of months, maybe a quarter or so of difficulty before that really sustained rally in risk assets begins.
Will inflation still be front and center in the Fed's?
It's interesting, by the way, calling for this potentially sustained risk asset rally next year. Interesting.
Institute. They're still very mindful of that it's not over completely.
I think that inflation is going to be almost the only thing that we're going to be talking about going into next year. What we've heard from the Fed is that actually economic growth, it doesn't need to slow in order to see inflation coming down any further. So from here on, the market's eyes have to be entirely focused on what the various inflation numbers are going to do, what's going to happen to shelter inflation, core services. It's really about what feeds into inflation.
Yeah, all right. We already know about this. So we're going to pull off this. Let's go ahead and get a little bit of looking here into some Wall Street commentary on the freight issue. Yesterday we talked Goldman. Today let's go ahead and talk B of A. So what do we got here? 2023 was bullish dirty tankers and bulkers, bearish containers. By mid-year, this is following Russia sanctions, following a 75% collapse in 2022 of container ship earnings. Earnings have softened since then, dropping nearly 40% on continued onslaught of new capacity. New capacity, by the way, is like, wow, we have this massive supply chain shortage in 2021 after, or sort of during the COVID pandemic. Let's order a bunch of new ships. And the ships show up in 2024. And just, 2022 and 2023, just as people don't really want to ship as much. But anyway, you do have this inelastic expansion of ships. It does take, sometimes 18 months basically to get yourself a new ship once you order it. Container freight is likely to sink in 2024, suggests Bank of America here. Let's see what they say here about the Red Sea. This is what I'm most interested in. The Panama Canal and Suez Canal, key choke points for global trade, are causing delays, diversions, and higher freight rates. Drought has cut the Panama Canal transits, while rocket attacks recently drove Maersk and others to pursue Red Sea transits, or pause rather, not pursue, right? Because we're going around the Cape of Africa. Our shipping equity research team pointed out that these bottlenecks will impact container trade the most, with 8.1% of global container volume traversing through the Panama, 28% through the Suez. Wow, 28%. That's one of the highest estimates that I've seen for container trade. That's almost a quarter of container trade. And think about it, that would be like your China to Europe style, right? Closure of these key thoroughfares would boost container demand by about 1.5% and 7%, respectively. That would be 1.5% for container trade and in the Panama, and 7% in the Suez. For tankers and bulkers, the closure of the Suez would add roughly 30% to transit distances and boost fleet demand 1 to 2%. Longer supply lines tie up more vessels, boost freight rates, and widen destination spreads. In other words, costs go up, baby. All right, we'll get some more. Oh, Jimbo's here.
Fortune on a quarter like this. I mean, you would have revenues that weren't that good. And David, we would be starting to think that activists are going to come in because they're losing so much money. They're making a huge amount of money with these revenue numbers. What are they going to make when they get it right?
If they get it right, though, isn't that the question? I mean, what's going on with Express? Because that's kind of the locus of the problem
There's
here,
some
right?
post office issues.
And speaking to a couple of holders, I mean, it's hard to understand whether there's a margin at all in that business. If there is one, it's awfully small.
Yeah, no kidding. That's actually why I personally don't like exposure to Amazon. I think that Amazon is basically in two big industries that are almost set up for perfect competition. That would be shipping and fulfillment. I think that's a very difficult business to make a profit in. And then you have cloud hosting, which has margin for now, but I don't think it will for the long term. Houthi leader says if Americans become more involved or if they target our country, we will not stand by idly and will target them and their battleships and interests with missiles. Nice little threat against America there. Taking a peek here at JPM, we expect both inflation data and economic data to soften in 2024, allowing the Fed to begin easing rates at 25 bips per meeting around mid-year, or quicker if the economy slides into recession. However, we remain cautious on risky assets. Yeah, I also, by the way, am not willing to take on the riskiest of stocks at the moment. And the broader macro outlook due to the interest rate shock that should negatively impact economic activity, fading consumer strength, decreasing housing liquidity, geopolitical headwinds, and expensive risky asset valuations. It has become consensus that a recession will be avoided while equity multiples appear rich. Credit spreads are tight and volatility is unusually low. Thus, even in an optimistic scenario, we believe upside is limited for risky assets, favoring cash and bonds over equities from a risk-reward standpoint. Yeah, I don't know about that. I don't know. I suppose it depends if you're talking super short term or what. But I don't know. I mean, maybe bonds. That seems to be a little bit more of a, maybe dare I say, no guarantees, less risky bet, but who knows? I mean, just based on inflation alone and the trajectory of inflation, I would argue that would be a fair statement to make. But with less risk can also come less reward. You go, all right, look, my stocks or your bonds are up 10%, and then somebody else will, oh, look, my stock's up 40%.
Look, I'm not going to go against you.
No, yields were fine. Seasonality was fine.
Right.
It's not volume or price. So what's the problem, at least in the point, again, of a couple of holders here? They're not getting the answers that they would
did you get
to be
this
able to
problem
really
with-
understand it. In terms of Express, by the way.
They're really still ranting on the various different shipping methods here. Anyway, client views by JP Morgan. This week we poll investors on their outlook for 2024 across asset classes. Our latest survey results indicated equity exposure sentiment is 53 percentile. 32% plan to increase equity exposure more. You've got 75% to increase bond duration in the near term. 64% believe the recovery in equities is likely to reverse soon. Yeah, probably. I mean, with the RSI that we have, where you need a little bit of red here. 61% believe yields are not too low following the recent bond rally. 57% do not believe markets are complacent around geopolitical risks. 43% believe crypto markets have overshot the expected impact of the crypto ETF. 25% believe Bitcoin will rally further on this next catalyst. Well, it's an interesting little summary there of some of the views that you see. All right. Did they get off Express yet? Or Express shipping over at FedEx? I don't think they did. Fine. We will look elsewhere. Let's see. So, energy stocks are analyst favorites in 2024. Or sorry, energy stocks, yeah, if I said that correctly, are analyst favorite in 2024 as they shun tech stocks. This is average spread between 12-month price target and current price shows energy the cheapest and technology almost completely priced in. Very interesting. Yeah, bonds rising again, leading to a drop in that 10-year Treasury right now. And a lot of folks believing we are ready for a little bit of a relaxation in the market. So we'll listen in. Let's see here.
Even with cost savings, and without those cost savings, by the way, they would have been loss-making at Express.
Right, but the cost savings make it so that
they had a margin of some kind, but it wasn't much.
I mean, take a look at like a company like Linde,
1.7%.
which is industrial gases, and their business has been flat for years. But because the margins are good, they've been blowing out the numbers. And there's a belief that when they get any sort of relief on growth, it could be gigantic. That's kind of how I feel about this company. Linde is incredibly well run. I'm not saying that FedEx is poorly run. I'm just saying that this is what happens. Is Linde's revenues are not anything special, but they make so much money. And the reason I mention Linde is because they're inventive. And I think not nearly enough is talked about with the most important deal in this country right now, David.
Yes.
Which is the Linde Exxon deal for carbon capture. I think
No. Carbon capture is like such a money loser. It's being done to try to justify the ESG ratings for some of these oil companies, and it's personally mostly. I mean, it's a revenue loser. It's not really proven effective. And in my opinion, it's very difficult to invest in carbon capture right now. But hey, you can still make a lot of cash flow from oil from those oil companies.
With Exxon is one of my biggest themes for 2024.
Great. I mean, Darren Woods was with me a couple of weeks back. We were continuing to talk about low carbon solutions. They have increased their capital outlay, but there is still question in terms of ultimate return that they can generate from that business at this point. So
True.
And that will continue to be a question.
Gotcha.
Meanwhile, broader markets today, Dow and NASDAQ riding 9-day win streaks. S&P within striking distance of a new record close, about 1% away. Jim, I mentioned UK and German inflation at the top, but German PPI year on year down almost 8. And we mentioned the 10-year there below 2.
Yeah, well, I think that, look, you would think that if we did, say, a big auction, German trust money would move here. And that's what's used to see. We used to see a lot of foreign flows. But right now, they don't go anywhere. I mean, they're willing to accept that return. The same way Japan's willing to accept these returns. I don't get it. Why? But I guess it's in the trust agreements that they can't do it, because it makes no sense to buy their 10-year if you can buy ours.
If you can buy ours.
Right?
I would think so.
Or are they listening to the various people who come on from the Fed who their goal is to confuse? They are.
Let's try Doomburger. Let's see what they have.
In more than a month after they reached a $700 million settlement with states over its Android app store. This involves 36 states, many consumers. It's separate from the Epic lawsuit loss.
Yeah, but remember that this is like Google's paying like 3 days worth of net income for this antitrust fine or whatever of the Apple or the Android App Store, and 630 million of the 700 million is going into a fund for customers. So it's not even a fine. Like literally like 3 hours of Google's net income is the fine. The fine is so small. The rest of fund for customers. Well, that's like a built-in ad for Google.
From express to ground. And
oh no, not more Express talk. Oh boy. Oh, the suits are just driving me nuts today. It's so boring. What is this? Fine. We'll look at the sticks. See what's going on the sticks. So, Zim up about 2.6%. Coinbase, unsurprisingly, up on these SEC BlackRock meetings. A lot of enthusiasm on that Bitcoin ETF, moving up about another 1,500 there, just as people are excited over the potential for this ETF approval to come pretty soon. I remember Gary Gensler even suggested recently that the SEC is incorporating new rulings by the courts, so to speak, and is optimistic or is essentially implying optimism on a BTC ETF as a result of that. So let's see what else is on the downside. Open Door, Matterport, and this is where it's in these risk assets. There's so much volatility right now on these that it's difficult to say, oh yeah, and even in a soft economy, we're going to definitely see the smaller companies, the small caps like a Matterport, do very well. It's interesting as well. Matterport stock is $794 million. It's one that I've watched this entire sort of down cycle. And in the down cycle, I haven't had exposure to it. Since January 22. The concern I really have with Matterport is you've got to wait for real estate agents to get enthusiastic again about basically buying Matterport gear to start scanning properties again. But there's so few sales and there's so few transactions that you can't really rely on real estate agents right now to boost Matterport. And they're at the same time, you kind of have this like unfortunate timing because you have more competition that's able to develop in the meantime, competing with these sort of LiDAR-based products that Matterport has. In fact, there's some pretty neat floor plan apps. Like I was using this floor plan app the other day. It's okay. I mean, I still prefer Matterport, like an Insta360. But Polycam was an interesting app. If you want to try that, it's not sponsored or anything, but you go to Polycam. That was an interesting app. I still personally way prefer the floor plans I get when I use the camera that I like, which is a sponsored product. It's the MetKevin. Just type into YouTube, metkevin.com/3D. It just redirects exactly to where the store link is for it. But metkevin.com/3D, that's what we use. And we could scan fast. We get quality. We get our 2D floor plans. We get our 3D floor plans. And we use it for HouseHack. We do all our before and afters with it. It's phenomenal. I think HouseHack got that for free, which is also kind of cool. So, yeah, actually, we did get that camera. That was totally free. Well, that's a good thing. Anyway, so yeah. All right, let's see. Doomberg, you got anything else? No, not more FedEx, please. My gosh, we talked enough about FedEx. It's exhausting. No, all right. Everybody just wants to be on commercial today. Fine. Losers. All right, let's see here. What else here? We have, don't you think sales will pick up when rates go down? Me? Well, you mean like real estate? Oh, I mean, that's entirely likely. The problem is everybody thinks that. And so I always get a little nervous when everybody thinks something. And then I try to think of, okay, well, what could derail that? Well, skyrocketing inventory could. You know, if inventory skyrockets and offsets the increase in basically buyer demand due to lower rates, then, you know, then you don't necessarily see prices skyrocket. I mean, it'd be great for HouseHack, but you know, I'm taking a more sort of flattish approach, at least for the time being, just to see what happens during spring. How many applicants are there for the Ethereum ETFs? Ooh, that's a good question. I know we've got about 13 for BTC, but I think there are maybe only about 2 or so for the Ethereum. So that'll be really interesting. GBTC is pure Bitcoin. Yeah, one of the reasons GBT, the Grayscale Bitcoin Trust, trades or has historically traded for such a discount is because of liquidity. You know, you can't really freely trade that at spot. So it's a closed-ended fund. It makes it a lot harder to get a true glimpse into you know, an ETF style product, because this is really a closed-ended fund. ETF should clear that up substantially, which will be very nice. So, all right, then let's see here. All right, Jimbo, you're up.
On the fact that they didn't know that Tesla's just harder to drive. They don't understand how to drive a Tesla, and they make mistakes. Didn't say that the Tesla was a flawed vehicle. He's continued to buy them because people want the largest car that's sold in America. But people don't know how to drive it.
Yeah, this is not involved.
That's insane. I can't believe you just said that.
Suspension, steering parts, which Reuters claims have been talked about online for years.
Well, also, I think that there's questions about how to fix what goes wrong, but it's not a recall issue. What I thought was really interesting about Hertz was that that Musk has always said they hold their value. One of the reasons they don't hold their value is everything you just said.
Hard to fix.
Yeah. I mean, David.
Although there were supposed to be very few repairs ever needed, right?
But that's not true.
Because there's so fewer there are fewer parts.
Well, that's the canard. That's the canard that Hertz has exploded.
I know. That was what was curious about it. Yes. Like, wait a second. We thought the maintenance was actually supposed to be a lower,
harder
percentage number overall.
Harder, and it's a Hertz problem. I thought, no, it's a Tesla problem, according to Hertz. It's a Tesla problem. So it is like he said, she said to some degree, but I think that the Tesla problems are so large at Hertz that it can't be Hertz. And people don't know how to drive them. It's just true. People have never been in one. I mean, it's not like they're putting...
What are you smoking, dude?
Electric tank or anything.
Yeah.
But they just, they get confused.
Yeah.
Meantime...
That's reasonable.
Like, that data is nothing. There's no data that say people are confused driving a Tesla.
Yeah, so that.
Which just adds to the theory that we're seeing a slowdown in EV growth.
I mean, the slowdown is real. And if you're Ford Motor, you want to... Well, you're not hoping for a slowdown, but you are the hybrid company. And everyone keeps saying that hybrids are where people want to be.
Yep.
I thought the F-150 Lightning was going to sell out because that was the inclination. That was kind of what we were getting. But obviously, that's not the case.
When it comes to Tesla, I think really a focus on China, not their manufacturing there. Obviously, the Shanghai plant is their most important, but selling there. The competition, from what I hear in China, in terms of EVs, is very, very strong now. And there's got to be a focus on their ability to maintain, if not increase market share, or even just somehow maintain at least to some level. You've got, you're talking about 34% penetration or adoption rates in China, on par with California at this point, far above those in the United States. And many manufacturers including those I'm told are making automobiles now at price points that are quite low, but a quality that is far higher than you might have anticipated.
Oh boy, if they let them in Secretary of Motors,
they won't let them in the United States.
They destroy our industry like
they won't let them in.
They just destroy it. Well, I mean, look, we have a steel business that they would have destroyed. Instead, we've got Nippon Steel paying a fortune for letter X. And we're going to talk.
All right, so yeah, very interesting. I'm not sure exactly where Cramer's getting this idea from about Teslas are harder to drive. As far as this idea about an EV slowdown, it's an interest rate sensitive sector. I mean, if you're going to see just across the board cars slow down, duh. Yeah, so that's not a horrible surprise. So, okay, now I'll pop for a moment here. We're about 10 minutes from the opening bell, and we'll grab some more research as well and see what's going on here. I was listening here for a moment.
And I would put us in this camp. What we probably expected or didn't factor in as much as we should have in 2023 is the immense amount of liquidity, primarily fiscal liquidity, right? When you think about what's happened with the budget deficit going from $1 trillion to $2 trillion, I don't think many were expecting that. Certainly the CBO wasn't. And then you also show this idea that the reverse repo market and the work that Treasury is doing around bringing that down from over $2 trillion to sub $1 trillion has infused a huge amount of liquidity into the markets. That's supported risk assets through all of 2023. The question is, do they still have those levers into 2024 to pull to maintain that elevated level of liquidity that supports risk assets? I think that's the right question to ask as we get ready to turn the calendar here in 2024. And oh, by the way, John, happy holidays to you, my friend.
Happy Christmas to you as well, sir. Can I just say that was a fantastic diplomatic dodge of that question I asked about 2 minutes ago, Daryl, but I won't ask it again. I want to talk about lessons from 2023 before you both go. A year ago, 12 months ago, looking out 1 year, looking out 12 months, the average forecast on Wall Street for the S&P 500, the average price target was 4,000 points. Based on where we are right now, we could finish 20% above that. Cameron, not everyone got it wrong, but most people did. When you reflect on lessons of 2023, does it help you as we look out to 2024?
Expect the unexpected, I think, is the key lesson from 2023. But I think Daryl's point about liquidity probably is the most important lesson. We weren't counting on liquidity becoming more abundant this year, mostly as the Fed was raising rates and continuing to do QT, but it did. And that was the key source of multiple expansion. The upside to the markets did not come from the earnings line. It came because the market re-rated 20% for the S&P, 35% for the NASDAQ. Yes, we rolled forward and earnings are a boost into 2024, but that liquidity tailwind was the key driver of this upside. So the ultimate question is, where does that go in 24?
Daryl Cronk, final word, please.
Money markets, baby. Well, cash from.
When it goes in the history books, will be a year of, falling inflation, which everybody expected, a stronger, more resilient consumer than I think most expected, including ourselves, tighter labor markets than most expected, and that abundance of liquidity. So I think what we've priced in now, John, in a lot of ways, is we've got all the macro tailwinds behind us, right? We've got the Fed rate cuts in, we've got the soft landing in, we've got the falling inflation or inflation having fallen. Now we need the micro to deliver into 24. We need companies to deliver in earnings growth again and not just multiple expansion. So I think that is what we have to watch as we turn the calendar.
Daryl Cronk, thank you, sir. Cameron Dawson.
There's a lot of this talk, by the way, on Wall Street right now about, multiple expansion. That's what's driving this rally. It's, valuation's too high. And don't get me wrong, I think there'll be a near-term pullback, which is be solely because of the relative strength index being so high. But I feel like that's always the argument. It's like, stocks went up and we're bearish, so multiples expanded. Okay. More money chasing less good stocks, right? So of course you're going to get multiple expansion. And that's the way to think about it. More money after all that inflation printing. Makes you wonder is it possible that multiples could basically reset higher once we're more in a stable environment, solely because of the amount of additional money that's been printed. I don't know.
It's one of those, right? I mean, you go to Target.
Oh no, Jim Cramer just drew a straight up to the moon line for a firm.
One of the great short squeezes, and today Mizuho contributes to it by saying that pretty soon there'll be direct deposit, David. You're going to have an Affirm card, rapid adoption, sounds a little like Block, formerly Square, full services. Affirm money account could turn plastic into gold. Boom!
I don't even understand what you told me.
Well, I'm just
direct
saying,
deposit of what?
Well,
What's getting direct deposited?
All right, let's just cut to the chase. David, $30 price tag goes to 65. Could you get me someone who's really tall here, please? Who's really tall here?
Carl's taller than both of us. All right. I got it.
It's called a squeeze.
I got it. It's called a
David,
squeeze. No, I know. This has hurt a lot of hedge funds right there. I'll do a little drawing.
And you know, there
a lot of hedge funds.
Oh, you mean like what? Were you playing Hangman?
House of Pain. You got
the
your
House
number?
of Pain, the HOP.
Yeah.
So they contributed to the HOP big time at Mizuho.
There you go. All right, we got an opening bell now only 4.5 minutes away. Imagine that. You can catch us anytime, anywhere by listening to and following the Squawk on the Street Opening Bell podcast. We're back in a minute.
Rip Affirm? All right.
How we work.
Okay, odds. All right. So let's look at what do we got with let's look at some Affirm news. Let's see what's going on over here. And let's look at them over here as well. Affirm. So, well, look at that. They were up 15% yesterday. And they're up another 1 point what do we got? 2.5 here in pre-market. We've got Affirm, expand self-checkout at Walmart stores. That was the yesterday news. And the price target was raised at Mizuho from 30 to 65. Wow. You know, I always think these price targets, they're just like after the move. That's when they're starting to be useful. Like where were the price upgrades for Enphase when it was $70? And everybody was panicking. And I'm like, bro, just wait for rates to come down. And no, all you get are price declines and deratings. It's so nonsense.
George Bory, and why the Goldilocks moment is upon us. Your opening bell just around the corner.
Yeah. But I think that's just the nature of these folks. So, okay, so another thing I'm looking at right now is Reuters has a sort of little bear piece here on Tesla. Tesla blamed drivers for failures of parts it long knew were defective. And I just sort of had this up as something that I've started looking at, and basically they're giving this analogy of a particular Tesla driver having their suspension fail, costing $14,000 to repair, and Tesla blamed a previous accident on the issue, though Reuters is essentially trying to claim that from interviews and records reviews, engineers at Tesla potentially knew about some of these issues for data between 2016 and 2019. So I think it's interesting. You know, obviously the closer you get to like the mid last decade, the older these, the less quality control there was for the newer company. I think Teslas have gotten substantially better than what we used to see. Even just the quality control on whether it's panel gaps or defects or otherwise. Remember, I had a 2017 Model X. I still do. And it had a lot of initial problems when I first got it. And I thought, well, it's just the nature of kind of having a sort of a newer generation vehicle. No excuse, obviously, for the problems, but I haven't seen as many people complain about those sorts of issues on newer manufactured cars, so that's pretty exciting. But anyway, yeah, it looks like Reuters is basically, slamming Tesla here for what they call, quote, creating a secret team to suppress thousands of customer complaints about poor driving range. The report, which found that Tesla rigged an algorithm to inflate the car's in-dash range estimates, sparked a federal investigation, and that there were about 600 injuries at SpaceX, where employees described a culture of rushing dangerous projects with little regard for worker safety. I mean, Reuters, it sounds to me like they got some shorts here on Tesla. But anyway, let's listen into the bell and we'll come back.
Take this, what I call offline.
Okay, we'll take it offline. But, Carl, looking forward to that opportunity to speak to him. Not just about, in fact, much more about the arc of his career, of his 14 years running Morgan Stanley and the changes that have taken place during that time.
Reinvention of certainly the emphasis of the business model, work from home, M&A. You can go all kinds of directions. I hope they give you some good time.
I hope our executive producer gives me some time. I think he might.
First location, Morgan Stanley.
Say again?
First location, Morgan Stanley.
Where?
2 Wall.
2 Wall Street.
Let's get the opening bell here and the CNBC Real-Time Exchange. The big board, it's Womankind, helping survivors of domestic violence. At the NASDAQ, it's singer-songwriter Walker Hayes celebrating the release of his song, Fancy Like Christmas. As we watch some...
Oh, it could be our first red day here in a while. Why is it so quiet at the exchange?
About the Red Sea.
Where's the cheering? Where's the cheering? Where's the excitement? There's no excitement. What is this? This is nonsense. Boring. I need excitement. I can't do this. Boring bell ringing there. Anyway, with the RSI over 80, a lot of folks widely expecting that today we are going to get a red day in the stock market. We'll see what happens. We just had the opening bell. We're down about 23 bips on the Qs. Looks like Tesla's down about 63 bips on the open here. SPY down 20. You've got a firm going up about 2.5%. Look at that, now about 2.7%. Trying to push again. 3% here on BTC as we're sitting over 44K. You've got Intuit up 5 bips. Trade Desk down about 1%. Enphase nearly down 1%. You've got Nvidia, that's after a 9% rally yesterday. You've got Nvidia. That is actually, it's not exactly sure what it wants to do. Down about 14 basis points right now, bobbing around. Etsy's bobbing around. Zim's sitting at about 2.8 up. Yeah, Apple's basically flat. Coinbase up 3%. You've got Bill.com down 66 bips. Google's up 1.63. So it looks like a market that's really trying to find trading direction today. Obviously, Bitcoin's moved nicely. FedEx now down about 12% at the opening bell. Oh, look at that. It is also trying to recover. Opened up about 12% down, now sitting at about 11% down. Q's really trying to find direction there, stuck at about 20 bips down. Does just trying to look like a green candle here, but still sitting about 20 bips down. Affirm just turned negative. Big red candlestick there. I don't know if that was Jim Cramer's omen or what, but I certainly, well, maybe I shouldn't say I certainly. I should say I may have perhaps tweeted that Jim Cramer just suggested Affirm stock will moon via short squeeze and drew multiple lines to the moon. Maybe. But anyway, this Reuters news probably going to hang on Tesla a little bit today. Dragging down that your left behind sibling in the Magnificent Seven. Nvidia just actually tried going positive. Interesting. Are we actually going to get that red day today? TBD, eh? I think there are a lot of people, frankly, waiting for a red day so that they can start allocating. That's very common, and it makes sense, right? I mean, you buy on red days. The problem is with buy on red days, and this is something that we balance out, and we talk about in the courses as well, as you balance out this like catalyst changes when you have an inflection point. If you wait for a red day, sometimes you're waiting 6 to 12 weeks, and so sometimes it makes sense to evaluate what a catalyst is. Obviously, here the catalyst was this incredible dovishness from JPOW, as well as the incredible rally we saw in the bond market yields going from July to October, and then of course followed by the dovishness from the Fed and an end to that sort of yield surge. All right, let's see what the live blogs got. So Treasury bull steepener is the path of least resistance today. Investors are likely to continue looking for any pushback from Fed officials on Wall Street, being overly optimistic on rate cuts. Investors are very much in end-of-the-month, quarter, and year-end mode, meaning an extension of the range today is likely the path of least resistance. Holiday trading conditions continue to limit conviction, though. Today's $13 billion 20-year auction, which represents the first coupon offering since the Fed meeting, is likely to be met with sponsorship. After all, bonds offer duration heading into the end of the period, right? So 10-year Treasury down about 3 basis points right now. All right, let's listen in here.
Protein intake and exercise, and we already see signs
Well,
that
that's why I've
demand
been recommending
for
Tyson.
protein powders, drinks, and bars is increasing. So he's
Well,
trying to-
that's true. I mean, the doctors, they need you that, but I think Tyson, because they've got the protein, but Tyson has not cooperated because they're one of the most poorly run companies I've come across in a long time.
Right. So he's talking about products that provide nutritional benefits to those who are using GLP-1s, mainly focused in North America, again, where the adoption is highest right now. And he says we're going to build on this broader geographic rollout as well as additional companion products and offerings. It is interesting, guys, though, to see him responding to it, and a number of other companies coming in with this idea that, and you lose muscle mass, particularly for those who are older. That can be a concern. And so you may start to see products that are based on how you add muscle mass while you're on, or maintain while you're on these GLP-1s.
Why don't the Tyson food people even talk about it? I mean, I'm sure they'll say they talked about it in some release, but it's such a natural. It's like, it's their sweet spot.
Protein.
That's who they are, the protein company.
Yeah, I know.
They don't call themselves
I'm just
protein
making the point.
foods.
Yeah.
They should definitely change their name because, like, the Tyson family itself is not, let's just say they've done a suboptimal job. Look, why don't you give me a 10-year chart?
Okie dokie. Boring. So let's pop in over here. What do we got? Q's sitting, actually trying to push up here. You still got that negative about 11% there on FedEx, and still red on Affirm. But the Q's really trying to push up here. So that'll make for a very interesting day. If today ends up green with this kind of RSI, I mean, oh boy, it's gotta have some bad news here at some point. But we'll see what happens. Okay, so let's see what else we have. We talked Donald Trump, we talked FedEx, we talked Costco's downgrade. Let's see here. We've talked Bitcoin ETF. We've talked real estate. We've talked ETFs. We've actually done a lot already. Isn't it actually pretty good? We're touching now a little bit on Tesla's hit piece here by Reuters. So I'm looking for some evidence over here. I'd like to see. I like how they don't even censor their "Go F yourself." That's funny. Reuters just going for the full quote here. So what do we got here? Looks like we got some images here of the front suspension arm in the Tesla Model S. Okay, in their parts catalog. The company has denied some of the suspension and steering problems in statements to U.S. regulators and the public. But according to Tesla records, sought to shift some of the resulting repair costs to customers. Tesla has blamed frequent failures on several parts on Tesla owners, alleging they abused the cars. This could be speed bumps or curbs or some of the allegations that you hear. So in other cases, the automaker charged customers with out-of-warranty cars to replace parts that engineers internally called flawed or had high failure rates. I mean, isn't that normal, though? Like, if you're out of warranty, even if a part has a higher failure rate, I'm curious, isn't that normal if out of warranty? I don't know. I always thought it was. Engineers ordered repeated redesigns for several parts and asked for money back from suppliers because of defects. Yeah. I mean, you would expect a company to do that. The records reveal persistent problems with low-tech suspension connections, as well as upper and lower arm controls, the fore and aft links. These parts are relatively inexpensive for Tesla and largely invisible to most customers, but they play a critical role in safety, connecting the car's axle and wheels to the body. Two more complex and expensive parts also failed frequently: the half shafts, left and right drive axles, steering racks, which needed replacing after sudden power steering outages. That some Tesla owners said nearly caused accidents. Wait, so they're not using... Wait, really? What is... This is very interesting from Reuters. So it's not data on accidents. In fact, just comments that some Tesla owners said nearly caused accidents. I mean, forgive me, like I'm trying to look at this like with a as unbiased of a view as possible, even though obviously I have exposure to Tesla, and I'm like, bro, where's the smoking gun? Where's the bad news, dude? Like where's the fact? And this is always why I personally like going through people's data. I'm like, look, if you have something that's truly bearish and you want to tell me about it, I am all ears. It's like yesterday in the chat, we had this dude who's like, oh, inflation's going to skyrocket again. And we're like, why? Give us one reason. It's like, I can't. I just believe it. And it's like, okay, that's fine. Then maybe say, my opinion is inflation is going to skyrocket next year, and I have no reason. That's very different from inflation's going to skyrocket next year. Like, it's a fact. At least 11 drivers told Tesla a crash was caused by a failure in Okay, here we now some data. In suspension, steering, or wheel assembly, company records show. These accident claims, which have not been previously reported to the media, were recorded by Tesla staff between 2018 and 2021 and assigned to engineers for review. Okay, so I wonder what the conclusion of that review was. 2021, the owner of a Model 3 with less than 15,000 miles on odometer went to a Tesla repair center in Brooklyn. Technician summary: front wheel fell off while driving on autopilot at 60 miles an hour. Well, that's the summary of what the customer said. That would be a problem if that was indeed what happened. Wrecked car was sold without the front wheel at an auction, records show. Oh, there it is. Okay. Ooh, look at that. There's clearly something that broke. So what is this? Front suspension, pictured above. The day after he bought the car new. Following month, another, well, that's problematic. If that's true. The following month, and that's a 2023, really, wow. Yeah, this is where you've seen a lot of people suggest, like, wait a minute, like, would they hit? I don't know. If they didn't hit anything, that'd be a problem, right? Following month, another owner of a 2020 Model X in Madrid reported a wheel falling off while driving. Neither driver is identified and does not detail how Tesla responded. Okay. This goes on for a while, huh? Yeah, it does. This is like 15 pages long of this. So I'm going to keep going through this and sort of evaluate what kind of... I want to see some like evidence and some more of this sort of evidence, and probably try to look into this a little bit, see if we can get a little bit more to that story. So we'll take a look at this. Very interesting, though. All right, let's listen a little bit for a moment. Oh, wow. Are you serious? Look at this. I just turn around and the market just goes green, basically. Tesla. Oh.
Gained the lead.
Back to that, trying to get back to that 258 resistance level for Tesla. Boy, it gets rejected there all the time. Somebody here writes, NYC potholes or car murderers. Yeah, I would assume if this was widespread as they are alluding to, they would have to recall these cars. Yeah, and that'd be more than a software update. That's true. Tesla had to replace the yoke wheel in my Tesla Plaid 2 times for free, and they took accountability. Mark, is that because the stupid leather comes off on the yoke? I've had mine replaced once because of the leather coming off, and it's doing it again already. It's pissing me off. I'm like, bro, I barely touched the steering wheel because it's on self-driving all the time. Do you concur with our yearly method of calculating inflation and how it resets when the year ends? Well, it doesn't reset. I mean, the actual nominal level of CPI is a number, right? It's like, what, 324 or whatever, and then as that number changes, it's not like there's a reset. I think what you're referring to is just the year-over-year lapping aspect, and that's, we should be fully aware of that, and that's why we like to prefer the month-over-month data. It's even though it's more volatile, generally what you do is you take month-over-month data, and then you just extrapolate that over, let's say, you take 3 months of month-over-month data, and then you create a trend. That's usually what you see to try to deal with that lapping issue that you're talking about. Tesla testing the fib line, exactly. Let's see here. Let's see. Look at the inflation similarities to the 1970s. You know how many times I've explained that, like the opposite nature of the 70s and today is pretty wild. I think if somebody's been watching my channel for over a year, you've probably heard me explain it about at least 69 times. But that's okay. You know, maybe you're new around here. Maybe you haven't considered the opposite nature of today versus then. But that's okay. All right. I need to make another cup of coffee too. But let me look at just a couple other questions here. And I want to see if Mark ended up replying. And then we got to go to course member live stream. Compare that to the amount of manufacturer defects in other vehicle manufacturers. Ooh, that's great. It's a great argument. Yep, I agree. The leather's not supposed to come off on the steering wheel, and I agree you wouldn't get that kind of quality issue on an Audi. I 100% agree with both of those things. Absolutely agree. Let's see here. Tesla is asking money back from the manufacturer. They should not be charging the Tesla owner. Well, yeah, if that's the case, you're 100% right, but we don't know if those things are linked just because Reuters wrote those two things next to each other. Girls are amazing. The little twin girls, they're really fantastic. You build the J-Pow statue yet? We'll see if they pull off the soft landing. Yeah, Audis do have great interiors. I mean, you pay for it, right? It's great. Very, very, very interesting. All right, so let's do a quick check of Enphase as well. Kind of curious just to see where it's doing. Oh, down about 1.3-ish% after 9% yesterday. Hey, look, it's back at 133. You know, now you could say your stock doubled. Anyway, from the whole, yeah, my stock doubled. Oh, how much money did you make on it? 0. Oh, so you just went back to break even? Yeah. Yeah, it's the stock market for you. All right, folks. Let's hit this button and then let's go to the course member live stream. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Boom, there it is. Okay, so yeah, again, we'll head on over to the course member live stream now. I gotta make another cup of coffee really quick. Thanks so much for being here. Remember to check out eHack throughout the day so you could get some more news in a text-based way. I always say, when you go to the pooper, think about eHack. It's the perfect time to check out eHack and get caught up. Thanks, folks. Bye.